real estate tax benefits. So first of all, I just want to start with a disclaimer that I'm not a CPA. I'm not giving you tax advice. Please speak to your CPA before doing anything about your specific situation. What we're going to cover in this section is just some of the general real estate tax benefits. So first of all, why does saving taxes make such a difference? So imagine you're an employee, you get paid $100, $40 disappears to the government, you're left with 60, and then 60 you can spend, invest, etc. Now imagine that you've got a company, and so $100 comes in, you spend all of the money on different investments, improving your business, research and development, investing in real estate, then only what's left is taxed, which could be zero. So you've got one situation where you're losing 40% essentially of the money first and then being able to use it, and the other where you can use all the money, and if there's any left, you pay taxes. And so over time, if you can save taxes or defer taxes, your investment and your capital is going to go so much faster. Say you have $100,000 to invest and grow. Over time, that's going to compound a lot more than if you had 100,000 capital event, you lose 40,000 and then you reinvest 60,000 over time. So of course, it's always better to minimize taxes or defer taxes where possible. We're not trying to say like you're cheating the system or avoiding the system. You're just using the rules, which are very favorable to real estate investors, in your favor to maximize the return on capitals that you get. And of course, the more tax deferred capital that you can put to growing as well, then over time your cash flow and your returns are going to be higher too. So for example, how can you use real estate taxes? Let's say you were to buy a self-storage property and you do a cost segregation study, and we'll talk about that in just a moment. And you have your depreciation allowance as well. A part of the property you can offset as passive income losses or depreciation losses. And if you're a real estate professional, you could potentially offset short-term capital gains, long-term capital gains. You can even offset earned income taxes or your income from investment funds or other assets that you own as well. So it's very, very beneficial. Just buying assets and having a stake in assets potentially gives you these depreciation, these passive income losses, which depending on your particular situation can then be used to offset a wide range of taxes. And as we just said, if you're offsetting these different taxes, it means you've got more cash, more capital to then reinvest and grow over time. And so, $60,000 or after tax money compounding versus before tax money compounding, in the short term, it's only a little different, but in the long term, it can make a huge difference to your overall returns on your investments as well. So you need to be aware of a few key important tax terms, expense deduction or write-offs. Let's say you have a business, a real estate business, you fly out of state to look at a property. If you're there mainly for the purpose of business, you can write all of that off. So your flight, your hotel stay, your meals, the different transport costs that you have as well. If you then keep all those expenses and receipts and make notes on them to make sure that it is related to your business, you can write those off. So rather than spending after-tax dollars on these things, you're using pre-tax dollars. Then for your real estate business, if you have admin costs, software, you're doing marketing, you have contractors, employees, you have a vehicle, all of these things can be written off as well. So reduce your tax liability, and again you're using pre-tax dollars for this, which is saving you money in the long run. Another key term you need to be aware of is depreciation. What's depreciation? Let's say you buy a building, a self-storage facility. That building isn't going to last for a million years. Sooner or later, you're going to have to repair it and replace it. So the government in the tax rules basically allows for this, allows you to depreciate the life of the building over time so that you can replace and repair it as well, because the government understands that, of course, the building isn't going to last forever. And for different sections of the building, they have different life cycles. For example, a computer isn't expected to last 25 years, whereas a building or land, etc., land is not counted in depreciation, but a building is expected, of course, to last longer than, say, office equipment. And so there's different time frames over which you can deduct the value of the asset. And so what depreciation is taking the value of the whole thing that you've bought, dividing it by the number of years that you're allowed to, and essentially you have this depreciation benefit. And for some items, you can depreciate all of that value today, year one. So let's say I spend $1 million to buy certain equipment for my self-storage facility. If that equipment's allowed in the short term, I can depreciate the full $1 million against my income and taxes this year. And if I don't use it all, I can roll it over to next year. Why is that beneficial? If you have a big loss now and you can carry that loss forward for several years, even though you have income coming in from several sources, net, you're still not paying taxes because you have a loss overall. Okay, accelerated depreciation or bonus depreciation is exactly what we just talked about. Instead of taking a cost or the building or the asset or the office equipment that you've bought and having a little bit of depreciation for several years, you basically accelerate that and bring it forward to today. And so it's an accelerated depreciation. Normally what would happen with depreciation is, let's say you have an asset that depreciates over 10 years. You paid $1 million, you can depreciate 100,000 per year for 10 years. Accelerated depreciation allows you to take that full 10 years of slowly depreciating and write it off today instead. Cost segregation study. So we're going to cover this more in a moment. Basically, it's how you can divide up the costs and assets that you've just purchased within a building to then over different life cycles, so your depreciation changes, and we'll explain that more in a second. Property taxes. So property taxes is a little bit different to your own income taxes, your own passive income losses, etc. The property taxes are on the specific building and due to the local city, county, state where the property is, and that's different. 1031 exchange. What this allows you to do is basically tax-free sell your asset because you're transferring it to someone else for equal value, essentially. So you can swap assets without going through a sale and then buying a new asset as well. So this becomes very useful in certain cases where you might want to roll up an asset, exchange an asset, subdivide an asset, etc. And in the case of self-storage, it's unlikely that you'll use this, but in other aspects of real estate, it's very important too. Okay, so cost segregation study. If you buy a self-storage facility, let's say the land value is considered 1 million and the building's 3 million. So you have 4 million overall. The land itself can't be depreciated. Why? The land doesn't lose value, it's not getting worn down, it's not getting destroyed, you don't have to rebuild the land, it's there, it's just dirt. But the 3 million of building is essentially, you know, over time it's going to depreciate in value, it's going to need replacement, and so you can separate that over, you know, 27.5 years. Normally what happens for most investors is when they buy an asset, they may then, you know, count 80% as building, 75% as building, 25% as land, and they depreciate the 80% over 27.5 years, which gives you, you know, a decent write-off each year. But if you do a cost segregation study, what you'll find is that, you know, maybe some of the asset is considered to be land improvement. Maybe some of the asset is considered to be office equipment or, you know, personal property. And these different types of asset, or, you know, these segments depreciate at different speeds. So you can basically depreciate more faster this way by doing a cost segregation study. So now maybe only 50% of the asset is considered building, 20-25% is considered land, and you've got 20-25% which is considered land improvement or, you know, office equipment, etc., which depreciates over 5 years instead of the usual 27.5, you know, for a building. So a cost segregation study essentially allows you to accelerate some of the depreciation that you have when you're making a self-storage investment. The thing to remember is that the reason we're doing the cost segregation study is to depreciate more now, and then those depreciation is essentially tax losses for you as the investor. So you can then go back and use those to offset the income that you have on, you know, income taxes, any other capital gains you've got, cash flow from properties. That's what these can be used for. That's why we do the cost segregation study. It all ties back and in. So just to summarize overall, if you have a business, you can write off expenses and then you pay taxes on what's left over. This is saving you tax. As an investor too, if you own assets and you do a cost segregation study and accelerate the depreciation, you have a tax loss which you can then use to offset different taxes that you have too. So these are all different ways of reducing your personal tax liability and your business tax liability. But again, what you need to do is speak with a CPA about your specific situation. If you're married, for example, and your spouse is a real estate professional, then the both of you can then use certain rules and certain tax write-offs. If you're not a real estate professional, then maybe you don't get the benefit of so many of the write-offs and different ways of using the losses as well. So it really depends on your specific situation. The key though is real estate is extremely tax favorable. So with this depreciation, with the cost segregation, you can essentially write off how much you invest, or even more in some cases, double what you invest as tax write-offs, essentially done right. And we're not breaking any laws here, we're not bending any rules. These cost segregation studies are usually done by third parties, accountants that have no swing towards you or another way. They're just fairly reporting how the assets should be divided, etc., and then how those passive income losses come about too.
For more information on commercial real estate investing, go to patriotholdings.com. Thanks for listening.